understand what causes support and resistance trend lines, we have to consider the human factors that give rise to these levels in the first place. Even in traditional markets like stocks, behavior is highly speculative. So it turns out that things like profit, loss, price to earnings, and other measurable metrics aren't always the main consideration. In fact, it often comes down to the shared psychology of market participants and how their emotions affect their decisions during changing market conditions. Widely shared patterns of behavior lead to the buy and sell orders that define key support and resistance levels. Sometimes behavior is based on cold, hard facts, but usually it is strongly guided by the hand of emotion. This is especially true in crypto. The better we are at predicting human behavior, the more successful we may become as a technical trader. There are several common behaviors in this section that we will study in order to better understand how psychology gives rise to support and resistance levels. Let's look at anchoring, which is a human behavior where a person or a group of people become psychologically attached to irrelevant information. If a large enough group of people anchor to the same irrelevant information or price point, then it can actually shift the market behavior in a self-fulfilling prophecy risen from herd mentality. For example, people tend to like round numbers, so if an asset is approaching, say, $1,000 then people take notice. But not because it is more important than $982 or any other random number. It is only because a large enough number of people tend to think to themselves, if it reaches this round number for a price target, then I'll take an action. As a herd, we anchor onto this nice round number, giving it importance and attention that it in no way deserves. The absurdity becomes even more clear if you price the asset in a different currency, say euros instead of US dollars. If you do that, the round number vanishes and you're faced with just another random price on the chart. When looking for anchor points like this, you will typically use US dollars rather than your local currency. When market participants become psychologically attached to historic price levels and trend lines, they're anchored to arbitrary levels. For example, when traders chart and trade on support and resistance lines or moving averages, they are partially basing their predictions off anchoring to historic price levels. Many traders are drawing the same or similar lines on their charts, focusing their attention on the same levels as each other, and they are all expecting those levels to play a key role in future price action. The attention generated by a shared group psychology has an astounding power to simply will into existence a tangible and impactful trading level. One can make the argument that anchoring bias leads to this circular feedback loop of attention and reaction, which in turn drives up the importance of those anchor points and lines. Other key levels people may anchor to are all-time highs, previous market cycle highs and lows, or event-based anchors such as CME gaps or the Bitcoin halving. Fear and greed are strong human emotions that play a central role in the market behavior that drives support and resistance. This is so important on a market level that companies like alternative.me attempt to track and measure emotion by distilling it down into a number from several indicators, into a fear and greed number that you can simply read. On a macro scale, fear may drive people to oversell assets, bringing prices lower than their fair value. The opposite is true of greed, which can drive markets into an overbought bubble. But we can also look at these emotions on a micro level and how they affect individual price levels in trades. There are three types of emotional people in any trade: bulls who believe the price will rise, bears who believe the price will fall, and those who are neutral or undecided. As they watch the price movement, their emotions and reactions will differ based on whether their psychology is bullish, bearish, or neutral. It is worth separately understanding the psychology when the market rises from when the market falls. When the market rises, the participants have a set of emotional reactions often dominated by greed, which isn't as bad as it sounds, and it can be justified if it's kept in check. The bulls are excited to see confirmation that they were right and the prices are on the rise. Greed and excitement may even lead them to double down on buying. On the other hand, the bears with short positions may fear losses. For them, if the price dips close enough to support, emotion may drive them to buy covers to limit their losses. Even those who have been neutral now fear that they're missing out, and greed may encourage them to buy in. All three of these psychologies could strengthen support and cause upwards price action. So greed can be a good emotion in that it encourages speculation. But as with all things, too much greed can lead to problems. It causes investors to hold on too long, to ignore their predetermined take profit plans, and can lead to overbought levels and bubbles. When the market falls from a support or resistance level, investors become fearful, and their actions are guided by those emotions. The bulls begin to fear that they were wrong and that the price may drop further, but they don't want to sell at a loss. So if the price approaches an overhead level near where they bought in, then they may begin selling off their positions to de-risk themselves. The bears, however, are excited to see confirmation that they were right, and greed and excitement may lead them to double down on their shorts if the price recovers a little bit towards the overhead resistance. Even those who are neutral will reassess their neutrality and potentially sell some of their positions to avoid future losses. All three of these psychologies could strengthen the overhead resistance. It really takes a mix of fear and greed to make any sell occur. But the final direction of the price movement is likely to follow the emotion felt most strongly by the largest number of people with the most money in play. What we've realized as traders is that fundamentals don't always matter when it comes to price levels like support and resistance. Mass psychology means that as more people pay attention to an anchor point, like a round number or historic value, the quantity of trades around that anchor grows, and it creates a positive feedback loop. Just by looking at and reacting to an anchor, they're essentially making it more important than it would have otherwise been. Making or losing money is an emotional experience, and whether market participants are bullish or bearish or even undecided, emotion is a central factor in their decision-making process. It helps carve out support and resistance levels by advising them on when to buy in or when to double down and when to cut their losses. They also tend to anchor their decisions to otherwise meaningless data like round numbers, lines on charts, and historic prices. CryptoMonk's content is not financial, tax, or other advice. Never transact based on it. Do your own research and consult certified advisors. Investing is risky and you could lose everything.